Till the bell here, time for a big picture discussion as we prepare for not just earnings, but a lot of economic data the rest of this week as well. Joining me, Kathy Jones is the Chief Fixed Income Strategist at the Schwab Center for Financial Research, and Ann Sonders is the Chief Investment Strategist at Charles Schwab. Great to have you ladies on this afternoon with a lot ahead of us over the next couple of days and week, really 2 weeks, I guess. Ann, when we think about stocks, earnings first, the baseline expectation with a lot of these companies close to highs, is it that things should go smoothly here?
Well, so far so good in terms of the traditional metrics like the beat rate and percent by which companies beat. What I find interesting about this season is the expected dip from about 13% growth in the second quarter to only 4.5% if you use that blended expected growth rate right now, back up to 11 or 12% in the fourth quarter. That seems like an odd mix for this sort of V bottom in earnings, which is why during earnings season, especially for some of the high flyers, I'd pay at least as much attention to outlooks and watch what analysts do for Q4 and maybe even into the beginning of 2025 to get a clearer picture of the sort of forward trajectory from an earnings perspective.
Okay. The big tech trades still dominant, but as we were talking about in the last conversation too, since earnings, like dominant from a market cap perspective, obviously, but we've had some pretty good strength in some of the other stuff throughout earnings. Does this have the potential, this part of the season, to skew that market cap back, Ann, or do you have a strong bias on kind of what type of breadth participation we might be seeing?
Well, I think on a day like today, when we had the breach above 4.3% intraday on the 10-year, I think that has been a contributor to some underperformance again by small caps. You still have about 43% of the Russell 2000 that is negative earnings, a similarly high percent that is some combination of not profitable and zombie companies. So on the margin, the moves up in rates tend to hurt those areas. But I think the broadening out is not from the Mag 7 to one other segment of the market. I think it'll be a series of rotations, inclusive of times like today, where you're going back into the mega cap tech and tech related names. It's just a little bit more of an on the surface series of rotations relative to what were under the surface rotations happening in the first half of the year.
To that point, Kathy, today we saw a pretty notable spike in yields early on, only to get some pushback. Seems like one of the first days in recent memory where the bond bulls were able to overwhelm. And I know your team's been looking for a little pushback to some of this higher yield steepening. What'd you make of the action today?
Yeah, the JOLTS report was, weak enough to take some of the fury out of the move up in yields that we've seen. But I think we're really sitting here waiting to see what the jobs numbers have to tell us and what the Fed does at its next meeting. So we've had, since mid-September, really stronger than expected economic data, and that, Citigroup Surprise Index, Economic Surprise Index, or the Bloomberg Economic Surprise Index really moving up and 10-year yields moving up along with it. So we've had a stronger economy, that we've repriced the path of Fed rate cuts to a slower, shallower pace. And now we're waiting for the next set of data. Unfortunately, the jobs numbers are going to be kind of a mess because of the hurricane and the Boeing strikes. I'm not sure we'll get a clear reading on what's going on from that. And then we have a Fed meeting. Of course, in the middle of all this, we have elections that have consequences in terms of economic policy longer term. So all of that has had the buyers step back. But now we're at yields, 430 on the 10-year, et cetera, pretty extended. If we get any kind of soft data, I would expect those yields to come back down a bit.
Okay, that's a good point. So I guess when we've come this far, bulls might be itching to jump back in if something doesn't, go as expected or come in as strong. Seemed like our ETF conversation earlier with State Street was about also flows pretty ready to pick up yields at this point. The 7-year auction, any sign of appetite there that might extend to the longer end of the curve, Kathy?
It's doubtful. 7 years usually kind of an orphan anyway. It's not a real popular spot on the yield curve. So those auctions tend to be kind of subpar most of the time. So I'd be surprised if people jump in to a 7-year or to even, a 10-year right now, just because why not wait and see what the numbers and the Fed tell us in the next week or so.
Fair enough. Liz Ann, on that subject, the market's basically saying 100%. Fed's going to give us another 25 bips after the election. Number one, should we expect that number to vacillate, to change at all? Or, are they confident that this response by the bond market to the first 50 bips is good? Part two is, do they want yields to keep going up?
Well, I think the jobs report on Friday will hold the key to that. We also get PCE, which of course is the Fed's preferred measure. PCE doesn't tend to print well outside the band of consensus expectations, because once you have CPI and PPI in hand, you can, at least talented economists can kind of map to PCE. So those don't tend to be a big outlier in terms of reports. But as we saw with the most recent jobs report, that can clearly move the needle. That was the deciding factor to sort of jam 50 basis points off the table. So could probabilities move between now and the November FOMC meeting? Yeah, but it probably would be because of a significant outlier in the jobs report that goes just beyond some of the vagaries, as Kathy pointed out, related to the Boeing strike and or weather.
That's a good reminder, too, on that subject again, which is that if the only thing that can move that a November cut odds would be a monster-like beat, it seems like probably unlikely to happen in a quarter, in a period that's got a bunch of weird things happening. But I guess volatility both ways, or is the bias generally that those incidents will keep numbers muted? I'll give you the last thought, Kathy.
Yeah, I think there is a case we made for a pause at the November meeting. If you're sitting at the Fed, and remember, not everybody was on board with that 50 basis points. They voted for it except for one person, but in the dot plot, it shows that they weren't all particularly enthusiastic about that. So they could pause and say, look, we don't have enough good data to tell us where things are going right now. Let's take a break until December. It's not likely. I think they would have signaled that ahead of time had that been the case, but you never know. So either a pause in November or December is not out of the question, and I wouldn't be too surprised by it.
Okay, thank you very much. Great stuff, ladies. Nice way to finish our session. Thank you, Liz Ann Sonders.